Hey guys, it is Julie here with TipRanks. In today's video, we're taking a look at 3 stocks that analysts from Goldman Sachs rate a buy. So let's get into it. Alright guys, welcome back and thank you all so much for being here. Like I said, today we're looking at 3 stocks that have buy ratings from analysts at Goldman Sachs with some pretty attractive double-digit upside potential. So we're going to take a quick look at these companies, what it is that they do, and how the other analysts weigh in. Just before we get into all of that, this is your friendly reminder that if you enjoy today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well so you can stay up to date with all of our latest videos. Alright, let's jump right into these 3 stocks. First on our list today is a company that pioneered ride-hailing, that is Uber Technologies. Trading under the ticker UBER, their stock currently trades at $43.75 per share. Uber Technologies helped turn the rides for hire world upside down when they brought ride-sharing right to everyone's smartphones. Their ride-sharing service is now available in over 10,000 cities worldwide, and you can get a ride from most major airports as it's available at over 600 of them. Uber has also expanded from their ride-sharing service into very popular service Uber Eats. Partnering with local restaurants, you can have a nearby delivery person deliver your favorite foods right to your door. Just this month, Uber announced that they completed the acquisition of the largest alcohol delivery service, Drizzly. The deal was done in a combination of stock and cash, costing Uber $1.1 billion, and gives Uber access to Drizzly delivery network in 1,600 cities across 33 states. Uber can now add delivery of beer, wine, and spirits to its services. During the pandemic, Uber did see a decrease in riders with many people staying home, but did see Uber Eats expand as so many people were now ordering in. Now, during their second quarter earnings report, which was a couple months ago now, they had earnings per share come well into the green with 58 cents per share. They saw an 84% year-over-year increase in their MAPCs, or monthly active platform consumers, and 105% year-over-year growth for their trips. Their revenue saw a 12% quarter-over-quarter improvement and year-over-year growth of 105%. With Uber gross bookings at all-time highs, they're expecting to deliver adjusted EBITDA profitability by Q4. Their next quarterly earnings report is coming up tomorrow on November 3rd, where analysts are forecasting a loss per share of 34 cents. Weighing in on the stock from Goldman Sachs is analyst Eric Sheridan. He says, across its array of products, we see Uber as the next large-cap platform ecosystem in our coverage universe, scale of use and economic capture around a common theme of local transportation and e-commerce. We are bullish on the concept of how a collection of products can capture increasing wallet share across multiple end markets with secular growth and rising online penetration rates. The Uber stock currently has 24 analyst ratings on it, and it does come in as a strong buy based on 22 buy ratings and 2 holds. The average price target comes in at $68.21. This would be a growth potential of 55% for the next year. Looking at the most recent ratings, on the low end we do have a hold rating, which still has an upside of nearly 15%. On the high end, we have a buy rating from BTIG with a price target of $80. That would be upside of over 83%. Second on our list today is a lesser-known company called SmartRent. Trading under the ticker SMRT, they're currently priced at about $14 per share. SmartRent is in the smart home automation niche, but with a twist, as they specialize in home automation solutions for multi-family residences. In other words, SmartRent brings smart home tech, formerly a valuable add-on for upscale homes, to the rental apartment world. Founded back in 2017, the company already has 182 total customers with 1.15 million devices installed and over 450,000 total users. SmartRent's products are scalable to different property types and provide services like contactless touring, smart parking where you can keep track of assigned parking spots and configure guest spots, access control to verify visitors are residents or logged guests, and smart home solutions that offer an elevated experience for residents and allow property owners to manage properties with one dashboard. Like many companies this last year or so, SmartRent went public via a SPAC merger. Their stock just began trading on Wall Street on August 25th after they completed a reverse merger with Fifth Wall Acquisition Corp. The company realized about $450 million net gains from the transaction. Shortly after this, on August 30th, SmartRent released their first quarterly earnings report as a publicly traded company. They showed a 274% year-over-year revenue gain from $5.8 million to $21.7 million. The company had deployed over 23,800 new systems since the second quarter in 2020, which was a gain of 234%, and registered an increase of 606 committed units. Overall, the company's customers own approximately 3.5 million rental units. Their next earnings report is coming up soon on November 9th. Weighing in on the SmartRent stock is Goldman Sachs analyst Rod Hall. He says that we believe the market for providing a software platform for managing smart home hardware for multi-tenant building owners is nascent, with potential for secular long-term growth. We note there are 32 million multifamily apartments in the U.S. with minimal smart home adoption thus far. Given an increasing trend towards modern hybrid working living spaces, we believe penetration of automation technologies is likely to grow substantially in the future. Now, the SmartRent stock hasn't picked up a ton of attention from analysts yet, and just has two current ratings that are split between one buy and one hold. Our hold rating comes in with a slight upside of 1.3%, where Goldman Sachs analyst is feeling a bit more bullish with an $18 price target, which would be an upside of 30%. And third on our list, we're going back to another well-known company, and that is Brinks. Trading under the ticker BCO, they're currently priced at $67.50 per share. Brinks is a well-known private security company, best known for their armored trucks. They offer a wide range of services, from this high-profile armored courier truck to their armed guard services to ATM installation, replenishment, and maintenance. The company has over 16,300 vehicles, 1.3 thousand facilities, and over 76,500 employees. They also offer tech-enabled devices for enterprises. Their technology helps to make trips to the bank a thing of the past, with reduced costs and efficient in-store cash operations. Back in May, Brinks increased their quarterly dividend by 33 cents, from 15 cents up to 20 cents. The company has been paying a dividend for 13 years now. Their most recent quarterly earnings report just came out on October 26th. Their revenue came in at $1.08 billion, along with earnings of $1.14 per share. This was an increase of 11% for revenue and earnings per share increase of 28%. Both these numbers came in above analyst expectations. Covering the Brinks stock for Goldman Sachs is analyst George Tong. He says that we believe BCO is well positioned to capitalize on an improving macro and retail environment, with revenue growth augmented by nascent digital cash management initiatives and further penetration of the unvended market. By the end of 2021, we expect BCO revenue will reach 100% of pre-COVID levels on a CC basis, providing an attractive base off which to grow. Notably, the combination of efficiency initiatives, acquisition synergies, and operating leverage is on track to drive 200 basis points of margin expansion between 2020 and 2022, contributing to healthy valuation upside potential. The Brinks stock currently has 3 analyst ratings, and it comes in with unanimous buys. The average price target comes in at $96 per share, which would be an upside potential of 42%. And most of our price targets are fairly close together, ranging from 40 to 43% upside. So there we have 3 stocks, all with buy ratings from Goldman Sachs analysts that think they have some pretty attractive double-digit upside. Of course, I always love hearing from you guys, so make sure to let me know your thoughts in the comments down below. Were these stocks on your radar already, and what do you think of their future potential? As always, please keep in mind these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Please make sure you're always doing your own research and due diligence before making any investment decision. Thank you guys so much for watching. I hope you have a fantastic day, and I'll see you back here next time.